I'm going to talk for hopefully about sort of 35, 40 minutes, and I want to have a good amount of time at the end for questions. Please feel free to grill me. You can disagree with what I have to say. I'd love to learn different viewpoints on this. So what I'm going to talk about today is the topic of responsible business, but in particular, three aspects of it. So what is it? And you might think, well, isn't that obvious? We know what a responsible business is, but I'm actually going to provide a different perspective than you might typically hear. Does it work? And also how to evaluate it, because Hamid was mentioning what you might be looking at in the exam in terms of trying to value companies and make this something which is concrete rather than just a nice idea. So I'm going to go through each of them in turn. Hopefully I'll spend most of my time on the third part. So the question was, what is responsible investing? Now, typically, we think about responsible investing as avoiding companies that do harm. We don't want to invest in a company that cheats on taxes, that mistreats its workers, that pollutes the environment. But I want to say that that is not enough. Right? We typically think about responsible business as doing no harm. But instead, I want to shift our thinking on responsible business and think about actively doing good. Right, so the point of responsibility is not just risk management, it's not just to avoid negative outcomes, but it's to do positive outcomes such as innovation. We often think that responsibility is about splitting the pie differently, so we're moving from here to here. So a company pays more wages or gives loads of money to Black Lives Matter, that's really good for its image, it's said to be fair. But why I want to change your thinking is I want to say that responsibility can't just be about splitting the pie like this. For two reasons. So number one, if responsibility is about making the company less profitable, then managers just won't want to do it. And indeed, you saw last year, 181 chief executives sign the Business Roundtable statement saying they would care about society, but many, they just didn't put it into practice. Now, many people might think, I don't care, right? Investors are often portrayed as nameless, faceless capitalists, right? They are them, society is us. If we can take from them and give to us, then that's good. But what I want to stress is that investors are not them, they are us. So this is why my view of responsibility is that it's about growing the pie. So the whole idea of pie growing is that you first think about how can I serve society, and then later on you might be able to benefit from this. So my definition of a responsible business is the following. It is one that seeks to create profits only through creating value for society. We're going to view profits as a byproduct of serving society and not the end goal. Are responsible companies ones that will actually do better in the long term, or are they just fluffy companies who are distracted from the bottom line? Well, I focused on employees because I had a very good measure available, which was the list of the 100 best companies to work for in America. And then, like we know, and as Howard was mentioning, correlation doesn't imply causation. Is it that employee satisfaction causes better financial performance? Or is it the opposite? Only once a company is performing well financially can it start to invest in employee satisfaction. So what I found was that the 100 best companies to work for in America beat their peers by 2.3 to 3.8% per year over a 28-year period. So that's 89 to 184% cumulative. Like when you value companies, it's not just sufficient to think about things such as profits and dividends and balance sheet, but to think about, is a company serving society? Because if it does, it might ultimately benefit shareholders in the long term. You often hear about employee satisfaction and these other things as being non-financial factors. But what the research suggests is that these are financial factors, right? So they will affect the company's performance financially. That takes me to the final part, which is how to evaluate it. So previously, how did we evaluate whether a company was responsible? It was through an approach which is exclusionary or screening. Okay, so this screen decided what the admissible universe was, and then out of the admissible universe, you would decide that purely on financial factors. And it might be there's a company which doesn't care at all about board diversity, but chooses to put a token minority on the board just to tick a box. So these box ticking measures are pretty easy to manipulate. And they argue, well, if the CEO is being paid a lot, right, that's at the expense of everybody else. So if the CEO wasn't so greedy, then maybe everybody else would be paid more. And the final thing was that a lot of these metrics focus on do no harm rather than actively doing good. And these limitations are serious, right? As Hamid may have already highlighted, the average ESG fund does not outperform. And I think it's because they're using these very unsophisticated measures. How do we then try to put this into practice? And so one of my other jobs is I serve on the Responsible Investment Advisory Committee for Royal London Asset Management. So we run 5 sustainable funds. So this is something I had first-hand knowledge of. What this is the idea of integration. So this means that we consider ESG factors alongside financial factors. So it's not that they're just the foot in the door, and once you're in, you consider only financial factors. What weight do we put on the financial factors versus the ESG factors? What we do at Royal London is we do what's called a net benefit test. So we're going to ask ourselves, does the company provide a net benefit to society? This is the really important point here, which is the point of materiality, which I'm going to go into a lot of detail. And Hamid said that this was something he particularly wanted me to spend some time on. One of the key reasons why companies fail to think about responsible business in a correct way is they think they have to do everything. Right, they need to serve every stakeholder and they need to take every investment. So I wanted to choose a French company here for an example. So Engie, the French energy company, they recently had to choose, do we shut down Hazelwood, which was the most polluting power plant in the OECD. Now, if they shut the plant, it would be good for the environment, but be bad for workers because 750 workers would lose their jobs. So if your purpose is to serve everybody, right, then how do you evaluate a decision which is going to be good for employees, or bad for employees, but good for the environment? So what materiality means is it means that out of all the stakeholders that we have, who are the ones that are the most important to us? Who is first among equals? So if you look at things like the Business Roundtable statement, they avoid the question. Right? They say we're here to serve everybody, but that makes no sense. And so this is the main thing that I think responsible businesses get wrong, is they forget that actually we don't have to do everything. We don't need to solve all of the world's problems. We need to focus on a few. So I think for you as investors, right, one of the important things to look at is the company greenwashing, trying to tick every single box, or does it know its place in the world and the specific social problems it's supposed to serve? And what this does is it goes industry by industry and highlights what are the most material stakeholder issues. So if we think about the first column, extractives and minerals processing, the environment really matters because you have a huge effect on it. But what if you're a bank? Right, well, the environment isn't so important. What really matters is something like selling practices and product labeling. You don't want to be caught in a Wells Fargo fake bank account scandal. Okay, so what that means is that, yeah, climate change is really important. I really care about it myself. But maybe if you're a bank, the main way that you move the needle is that you're very transparent to your customers and you avoid these problems with data privacy and customer security and so forth. And that links me to my final academic study here. So what this paper looked at was it looked at the MSCI ESG rating. And they look at companies that do well across the board on every single dimension of customers, employees, and the environment. And they find that the ones that do well across the board they don't actually beat the market. But when they redo it and they look at companies that beat the market on the material issues, but they scale back on the immaterial issues, they do beat the market by 4.8% per year. So let me strip back from the study. What is the key punchline of this? Is that when evaluating companies, don't have a box-ticking idea that a company needs to do well on everything. Instead, think about what are the specific material dimensions for that company, make sure it does well on that, and if it's scaling back on everything, well, that on other things, that's not necessarily bad, it just knows what its priorities are. So MSCI is a rating provider, Sustainalytics, Thomson Reuters, Bloomberg, they are all other providers. And what they do is they analyze company reports and World Bank reports and other things to try to rate a company's sustainability, just like credit ratings, like S&P and Moody's do that for creditworthiness. Now, the big problem is there's a huge amount of discrepancy between the ratings. So if you look at creditworthiness, S&P and Moody's, there'll be a correlation of 0.9. People will agree on what the creditworthiness of company is. But the correlation for companies is for sustainability is really low. So people just can't agree. But what is the punchline for all of you? So what it means is you can't just take an ESG rating off the shelf. We're going to buy every company where MSCI rates them AAA. So some people will look at the low correlation and say ESG ratings are completely useless, but that's throwing the baby out with the bathwater. Read the actual report and think about, well, what is it that goes into the rating? So one simple analogy I'll often use is when you choose food, you can look at the overall calories, but that doesn't tell you much. What you want to look at how much of the calories are from protein versus fat versus carbohydrate, and that disaggregated number is much better than the overall numbers. And so what I've done is I've come up with a list of 10 questions after speaking to investors about this for so many years. Purpose is just as much about knowing what not to do as what to do. So a company whose purpose statement covers everything, that's not that useful, but if there's ones which will highlight what they chose not to do, that's valuable. Here, a purposeful company will be excellent in areas even if they are not linked to shareholder value. Just like Hamid kindly said, right? So a purposeful professor will try to devote a lot of attention to teaching, even though teaching does not enter tenure or academic ranking or status. Right, this tells you who are the CEOs who care about their workers and who are the ones who just view them as being delegatable to HR. As Hamid says, what I spent 2.5 years doing is to write a book about this. And like, why I wanted to write about this is to show how responsible business is something which is realistic. So often people think that responsible business is fluffy and worthy and tree huggy. I wanted to write about this as a finance professor. Finance professors normally have no emotions and no sentiment, but I wanted to show that these are things which is commercially important and to provide a framework to put it into practice. And I wanted to base it not on wishful thinking, but a lot of academic evidence. But unfortunately, academic papers are written in a very dense way. So I wanted to make this accessible for a general audience. And so that's what I came up with. Thank you so much, Hamid, again, for the really great opportunity. Let me go back to you for questions.
Think about a discounted cash flow valuation. So our value comes either from the cash flows on the top or the discount rate. So how should we think about the effect of the social responsibility?
Thanks, Hamid. So I think the main mechanism through which it affects valuation is through the cash flow. Now, in terms of the discount rate, so one argument that people make is that responsible business is about risk management, reducing systematic risk. And then there is at least one academic paper in management science which suggests that. But actually, I think what I've tried to highlight in this talk is how responsibility is not just about risk management. Yeah, that's part of it. But really, mainly, I think responsibility is about actively doing good. And this goes to Thomas' question, which he's put on the Q&A, which is a great question. So for those who can't see it, he asks, what could we expect from businesses in the light of COVID-19? Responsibility in this crisis has been about pie growing, not about pie splitting. What do I mean by this? Historically, we see responsibility as being throwing money at a problem. So giving a massive donation or giving a huge wage increase to your workers. But companies really can't do that right now just because they don't have money. So instead, what has responsibility involved? It's involved excellence and innovation and creatively thinking about what can I actively do good here? So some of the examples like LVMH, for example, they're now changing from making perfumes to sanitizer. Right, that's something if they hadn't done it, there would have been no media backlash, there would have been no outrage, but it's something where they're thinking proactively, how can we use our expertise? If you can split the pie differently, do so. So there's some companies where the CEO is taking no wages, and there's some companies who are keeping to paying their workers even if they're furloughed. But I think we need to move beyond that because not every company can do that. I think the idea of happiness is interesting because often people think, well, we want to delegate and empower workers by giving them a lot of freedom. So people talk about the Google 20% time where they spend one day a week doing whatever they want to do. But I think that's a little bit misleading because that's a bit one size fits all. So the correct corporate culture depends on the organization. For example, in the military, there's strong rules there. You don't want people doing what they want to do, but that's fine because of the actual environment. And similarly with something like Amazon or Walmart. So Walmart, I know they have efficiency and processes, and that to some people is good because it provides direction. Now, I am concerned about some of the practices within the warehouses, but the fact that it emphasizes efficiency rather than creativity is not necessarily a bad thing given the organization.
Manu is asking, what is the role of government?
Great. I do think there's a very strong role for government. You can't really legislate responsibility, but you can legislate, don't mistreat your workers, but you can't legislate, innovate in order to think about making sanitizer rather than perfumes. So what I've emphasized in the talk is that many things that you do to help society do help you in the long term, such as treating employees well, but there's certain things where they don't even affect you in the long term. So maybe carbon footprint, right? So you might pollute far more than it affects you in the long term. So the goal of the government here is to prevent these externalities either by ruling out certain behavior, like you can't dump waste or something, or by taxing them, such as a carbon tax. I talked about the importance of growing the pie, creating social value, but also the division of the pie is important. And that's something the government can do through taxation of wealthy people and also spending to help those who are displaced, for example, through technology and automation. The idea of competition is that there's a company which is irresponsible, then customers can walk away from it and employees can walk away. But that's not going to be the case if there's no competitors. So I think one of the key roles is to make sure that there is competition that a government can play.
She was saying that what are the steps for a company to implement sustainable responsibility in its business?
So I think the first thing is to define for yourself what your purpose is. And purpose needs to be focused and targeted. What are the specific ways in which you want to serve society? Then I'd say define what measures you're going to look at to try to track how you are actually putting purpose into practice. And these are measures beyond the financial measures. And then third, to commit to report this externally to your investors and stakeholders. Why? Because it then means that you will be evaluated not just according to your financial performance, but according to whether you do well on those external measures. So number one, define it. Number two, embed it by thinking of measures to track your progress. And number three, communicate that externally so that you're going to be held accountable.
So the very last question is asking, what advice do you have for a young professional who has passion to create value for society?
The main answer to that question is you think about your first job after leading EDHEC as being a second degree, but one that you get paid for doing rather than actually doing. So where are you going to learn from the most? So one of the biggest pieces of advice that I was ever given was you can do everything you want to and be everything you want to be, but not all at once. So what that means is we live very long lives now, right? So we're going to have long careers. And if you want to do responsibility, it doesn't mean that you do it immediately from day one when you leave EDHEC. It could be that you spend a couple of years learning the commercial, the nasty, difficult side of business, and then you make the pivot later, just like I started doing Morgan Stanley, then academic research, now I do more practitioner stuff with things such as the book and the policy involvement. There's one question that was asked twice. So Marine, I think, was particularly interested in this, which is the Black Lives Matter movement. So she asked, do you think if a company does not communicate on its position, it can be assumed to be socially irresponsible? And I actually say no. And why I wanted to answer this question, why it struck me, is that there's a lot of companies where they saw Black Lives Matter and they decided, oh, let's post a black square or come up with some statement, or let me donate €1 million to Black Lives Matter. Now, clearly, I'm someone who cares a lot about racial diversity. I'm someone who is personally affected by this. But I think with something like that, it's just too easy to make a quick, superficial statement like posting a black square or making a statement. It's much harder for a company to actually put this into practice by saying we're going to be committed to having some bias-free evaluation and hiring processes and trying to put this into practice. So I think some of the most responsible companies are often ones that go about it quietly, thinking, oh, maybe we're not going to use the most eye-catching action. And sometimes, like if you donated to charity and you did that, it wouldn't be a bad thing. Thank you so much for the opportunity, and take care, everybody. Thank you so much for your interest.
Thank you. Thank you very much, Alex.